Welcome in a global voice. Richard Perry of Hantec Markets is joining us right now on the show. Richard, thanks very much for taking out the time. Globally, I mean, it's a holiday season. It's a little bit more quiet. Markets are perched at their record highs. Do you see this excitement that we have in the equity market sustaining?
Yeah, good afternoon. I think what we've got is this run higher in equities, which has been driven by the latest breakout through the trade dispute with China, looking to move through the phase one of the trade agreement. But it's interesting that we're starting to see a little bit less positivity surrounding this, some question marks surrounding how the translations are going to be put across, whether there's going to be some devil in the detail, and that could be a bit of a risk coming into 2020 as those translations move through to the signing phase of phase one. Now, what we see at the moment, I think, is certainly risk positive through this, but we could see a bit of a correction also, because some of the positive risk factors that we saw last week are now starting to unravel a little bit. Certainly the Brexit situation is coming back to the fore again, with Boris Johnson, the newly appointed Prime Minister of the UK, certainly coming across suggesting that he's going to adjust the withdrawal agreement, and that produces a bit of an extra risk factor back into UK assets once again.
So Richard, currently we've heard a lot about how this rally has been driven by the immense amount of liquidity that there is, a worldwide liquidity rather that there is, so even emerging markets for that matter. India is trading at a record high. Do you see this liquidity actually getting supported by fundamentals picking up?
Well, certainly I think if phase one can get through in a position whereby we think that it's a risk positive for the markets, and they can then move towards phase two and a proper trade agreement between the US and China, then we can start to see the horizon getting a little bit brighter, I think, because certainly throughout 2019 we've seen this drag on sentiment through the trade dispute between the US and China, and if that can get lifted, then we can certainly look to push forward again. I think we're starting to see the Eurozone bottoming out in terms of some of the economic data there. Also, the US has been drifting lower in terms of the economic data, but we could also start to see that starting to bottom as well. If Brexit can get sorted once more, that is another risk factor that we see that gets removed. So the horizon isn't necessarily all that positive at the moment, because there are still some uncertainties, but if these situations can get pushed forward, such as phase one into phase two of the trade deal, then I think that the fundamentals can start to turn around.
What is the conversation that's happening now with regards to 2020, and what's going to be the focal area?
Well, as I said, I think certainly we've got this the US-China trade dispute. We've got the global economic slowdown, which has been continuing through 2019. Once again, I reiterate, if these situations can start to look forward and see a floor put under the trade dispute between the US and China, then I think that generates some confidence once more. I think how the US consumer responds in 2020 as well will be interesting, and whether they can continue to remain positive, because I think that has been underpinning certainly the US markets, and I think that can translate through to the global stage as well. So I think that what we've seen is the US consumer effectively holding up a lot of the global economic slowdown, and if that can push forward with the US consumer still supporting the markets, then I think that is a positive that we can look forward to.
Hi Richard, good afternoon to you from India. While of course there is some headway with regard to US-China trade deal, UK election, we've got a decisive verdict coming there. I think the world will now focus on the US President impeachment proceedings. I think they begin today with a debate. That's how the process starts, and we've been reading how US President has written to the Speaker Nancy Pelosi to stop this process. Do you see all these developments having any sort of repercussions on the market? Even the US markets, by the way, have been trading at their record high levels.
Well, that's a good point. I think the fact that what we have is this impeachment process coming through the House of Representatives, but I don't see it really gaining too much traction. It will get through the House of Representatives because the Democrats have got the majority there, and you only need a simple majority to impeach President Trump. But then you get the difficult part, which is the Senate, and the Senate is not going to confirm that impeachment. There is a majority for the Republicans in there, and you need 2/3 majority to vote against President Trump, and I just don't see that happening. I think the markets are paying very little attention at the moment to this impeachment process. It is obviously has the potential further down the line to be impacting on President Trump and his re-election later on in 2020, but I think at the moment markets are not really paying too much attention to it.
This will definitely grab the headlines. It could turn out to be a non-event for the global equities. But I'm just going back to Brexit. While we've got decisive verdict coming there, Richard, there are reports indicating now it could be hard Brexit, which means that the deadline of December 2020 may not get extended. In case if there is no agreement which is signed between UK and the EU region, and if the Brexit takes place, what sort of impact do you see on the trade then?
Well, that again is a very important risk factor that we need to consider for moving through 2020. I think you're going to see a lot of volatility surrounding this Brexit story once again, and how the trade negotiations go between the UK and the EU after the UK leaves or gets the withdrawal agreement passed through at the end of January. The big next step is the trade deal, and how that trade deal progresses through 2020 is going to be important. It's very unlikely that you're going to get a wide-ranging trade agreement done in the matter of, 11, 12 months. I think that the only real expectation you could have on a positive outcome would be a very skeleton deal where you get a lot of the trade processes just cut and paste over into the new deal. I think that markets are still going to play into the fact that any sort of hardball that Boris Johnson tries to play throughout 2020, I think, are with regarding to this deadline of December 2020 for the transition deal, transition period ending, I think is going to be a factor, and I think that there's going to be volatility certainly surrounding sterling and UK assets on the back of that.
And the rally globally that we've seen for equities, at least in 2019, has been driven by liquidity. Do you think this trend will continue even in 2020? And if that's the case, what sort of allocation of funds do you see for emerging markets? And in that basket, what's the view on India?
Well, I think what you have is that into 2020, again, if the trade process between US and China can have a line drawn underneath it, then we start to see the funds and capital flow moving away from the US assets, more towards emerging markets, more towards the higher risk end of the scale. And I think that is clearly going to benefit the emerging market equity funds that obviously would benefit from that flow. And I think that would be something that we'd need to look out for through 2020.
Richard, it was great chatting with you. Thank you so very much for joining us this afternoon.